My guest today is Scott Sumner, the Ralph G. Hawtree Chair of Monetary Policy at the Mercatus Center at George Mason University. Scott is an influential blogger on monetary policy at EconLog and Money Illusion and has written a new book called The Money Illusion. We'll be covering that and much more today. Scott, welcome.
Thank you for inviting me, David.
So I'd like to start actually in an area that you haven't commented on much before, but that's cryptocurrency. And to me, if I think about programmable money, that offers a lot of interesting possibilities to the control of monetary policy in an economy. And so here we'll have to assume that the monetary policy in an economy is represented in, or the money in the economy is a cryptocurrency. So programmable money, if it gives us infinite control over the money supply, because you can program whatever algorithms you like to add or take away money to whomever you care to, and you can actually be omniscient about what's going on. You can see all the transactions in an economy and measure them and track them by software. So you know everything and can do anything. How would you design the monetary policy for a cryptocurrency?
Well, that's a very good question. I probably would continue to favor something kind of like nominal GDP targeting. In the scenario you described, it should be easier actually to accomplish that because you wouldn't have the information lag we have now where we don't know for weeks or months what the data is going to look like on, the level of nominal spending in the economy. So either cryptocurrency or actually any kind of electronic money that gave you real-time reading on the level of nominal spending should make it easier to stabilize nominal GDP. And the actual techniques used would be pretty much the same as under traditional monetary policy. You'd adjust the quantity, nudge it up or down to keep nominal GDP on target. Now, you may not want to necessarily target the current level of nominal GDP. There's a pretty good argument that the economy would be more stable if you target expectations of nominal GDP, say 1 or 2 years forward. And that's especially true in a scenario like COVID, where it's probably optimal for nominal GDP to briefly decline rather than try to artificially prop it up last spring. But you'd like it to return back to the trend line in not too distant future. So in that case, you'd create futures contracts and you'd sort of peg futures contracts linked to nominal GDP, and you'd use monetary policy to stabilize the value of those futures contracts.
One of the things as I was pondering this world, I started kind of asking all kinds of inconvenient questions about so what is nominal GDP? And you have an interesting definition. Well, I think it's a pretty standard definition of it. It's all the spending that happens in an economy. But when you think about cryptocurrency exchanges, it's simply sending money to somebody. And nominal GDP, I think, tracks a certain kind of exchange, like a special kind of exchange, which are commercial exchanges, right? So if I just gave you money, Scott. I just handed you $100 of bit things. That wouldn't be nominal GDP. I don't know. Would every transaction be counted, or would you need to designate certain special transactions?
No, most transactions are not part of nominal GDP. Let's start with the financial system. Transactions in the financial system are far larger than nominal GDP, but they're not counted because they don't represent production of goods and services. So nominal GDP
buying assets, you mean?
Yeah, trading securities, trading foreign exchange, trading bonds, all that stuff. So the amount of transactions in the economy far exceeds nominal GDP. By the way, in a trivial sense, also when you buy and sell used products, that's not really part of nominal GDP either, because those were produced in an earlier period, like garage sales, things like that. But so the question is then, why do we care about nominal GDP? Why don't we just care about all transactions? Why don't we want to target that? Well, there's two reasons for caring about nominal GDP. One is stability in nominal GDP helps stabilize the labor market. And second, it helps stabilize the financial system. Because nominal GDP is both the sort of total gross flow of revenue in the economy and the gross flow of income. So if nominal GDP goes down sharply, there's less revenue in the business world to pay wages and you get high unemployment. If nominal GDP falls sharply, you have less total income in the economy to service debts and you have a lot of debt defaults and a financial crisis. Now that's not necessarily true when there's a drop in other types of transactions. Right? So you could have a drop of transactions in the foreign exchange market that's very, very large. Just for some reason, people aren't trading foreign exchange as much, but that wouldn't cause high unemployment and debt defaults in the way that a drop in nominal GDP would. So there really is a specific reason to focus on that kind of transaction as being important for the health of the economy.
So we would need, in our little universe here, we would need to carve out certain kinds of transactions. So in the kind of the jargon of the crypto world, we'd need two kinds of wallets at least, right? We need a kind of wallet that receives, I guess, commercial transactions, right? So receives revenue, and another kind of wallet that maybe that same wallet pays wages. So because you're saying revenue and wages are special and other transactions are not. I got that right?
Yeah. So here's how I would put it. There's really two questions here. If we're using the current techniques for stabilizing nominal GDP, current types of monetary policy, we don't really need to know which transactions are for which purposes, because they don't know that now with US dollars. The Fed doesn't know how many dollars are spent on this or that. Instead, they directly monitor the variable they're trying to stabilize, right? So they estimate NGDP. However, if you want to do a next level monetary policy where instead of reacting with a long delay to data, you actually see real-time data on nominal GDP, then you do need to know where this stuff is spent. So you'd need to have real-time data on how much is spent on retail stores or how much is spent in the service sector and things like that. And I don't know enough about cryptocurrency to know how hard it would be in a centralized system to have that kind of data. But I mean, you could certainly imagine a future of some sort where all money is electronic and there's an enormous amount of real-time data on the economy so that we would have at least a pretty good estimate of current nominal GDP. How precise that would be, I don't know. Like, if you break the economy down, you have some firms that are large and sort of easily monitored. Like, you could imagine Walmart providing everyday data on how much electronic money is spent on their firm, right? But then maybe a little mom and pop store, you don't have that information unless you have some way to centrally monitor it by having, all transactions tagged in some way. Like if you have some sort of future economy like 1984 where the government is watching everything and even every little small business has a code number associated with the business and every transaction shows up with that code number and so on. I mean, I could imagine a scenario where you could monitor in real time how much is spent every single day on nominal GDP type transactions. But that would require a lot of data collection.
It would. And well, one of the nice things about neither you nor I being software developers, that we can assume that job is easy and say, well, let's just make up that we can do all this. Now, how would we design the ideal system? I'm wondering about revenue and wages, about whether they are equal in your model or in the model we're kind of building here, or whether you would put more weight on one or the other. Because at least in the popular conception, I care more about wages, I think, than I care about my company's revenue, right, or any other revenue. Is that kind of that follow through and that being more important variable to track or target?
Yeah, and before answering your question, let me back up so I don't get in trouble with your readers. I actually view the system I'm talking about as a dystopia. I'm not advocating it. Now, to answer your question, so I think you're kind of right, but for the wrong reason. Like, it probably is true that the wages part of nominal GDP is more important than the profit part, because the wages part is probably going to be more effective in stabilizing the labor market. We worry more about unemployed workers than unemployed machines. So, but it's not so much because, we think wages are important to us that's the variable that we might want to stabilize. As an analogy, the reason most people don't like inflation is because they don't like to pay more when they go to the store. But that's not why the Fed tries to control inflation. They try to control it because they think it leads to a more stable macroeconomy. They see inflation as zero sum. Some people pay more, some people receive more, right? So when we're thinking about the macroeconomic benefits of some sort of stabilization, we want to think about what the ultimate goal is and what instruments are most effective in achieving that goal. So because I believe that unemployment is one of the most important macroeconomic problems, stabilizing the growth path of total wages is arguably more effective than stabilizing the growth path in total nominal GDP.
Imagine this kind of world where, in such a universe, and back to our crypto world, one of the things you could do is you could have monetary policy act as like a tax or a bonus on transactions. So let's say we had this special wallet that was a merchant wallet, and I spent some money there, and suddenly the algorithm recognizes, oh, the economy is running hot. There's too much activity going here, and so they put a little sales tax on my transaction to, one, disincentivize me from doing it, but two, to actually drain some money out of the economy, right? And so you can actually enact a contractionary monetary policy through the point of sale, right? And so that analogy, and let you react to that, makes monetary policy in kind of this perhaps dystopian, idealized sense, a tax or a bonus on consumption. Does that make sense to you? Or
Yeah, I would actually call that a fiscal policy, though. Maybe it'd be a fiscal policy implemented via the monetary system. But if you're actually taxing sales to discourage sales, I would consider that more of a fiscal policy. But I mean, you're right. You could, in an all electronic money system, there's ways in which government can do policy more quickly and maybe effectively than in the current regime. Now, something that's similar to that, but is not fiscal policy, is adjusting the interest rate on money, either positive or negative. It can be either one, right? So if you want people to spend more, one way to do that is to increase the velocity of money by essentially taxing money, discouraging people from holding money.
yes.
And if you want people to spend less, you can subsidize the holding of money by paying interest on money, so that people are more content to just sit on their money holdings rather than spend the money.
Now, so let me keep going on this for a sec, because if I think of the goal of monetary policy as actually, let's say NGDP, right? So to me, NGDP stabilization, or the path of NGDP growth, then if in my kind of concept of like this, I agree with the idea that that the link between the word tax and fiscal policy, but it doesn't necessarily need to go to like a treasury department or be used for the revenue. Doesn't need to be revenue for the government. It could just get extinguished. Like you could just delete the money that comes in through this policy, right? It could just go away. And there we wind up draining some NGDP from the pool directly without it having to do anything other than just go away. The difference is, instead of draining it from a savings account, you're draining it from a transaction, from consumption instead of savings, right? Now, I don't know the implications of this. That's why I'm talking to an economist about it. But I think that if you see what I'm kind of trying to get at here, I'm trying to like see if we can move the transmission of monetary policy away from the asset market and into like the consumption market without having governments necessarily be involved in a fiscal sense.
Yeah, I'm thinking out loud. That might be harder than you think, because the Federal Reserve, for instance, is part of the consolidated government budget, right? So, like if the Federal Reserve pulls currency out of circulation and burns it, it's really no different from the Fed pulling currency out of circulation and storing it in a room. Because to the Fed, currency isn't really money, right? Something they've created, right? And so, let me give you an example that I've thought about and see if it relates to what you're saying. So some people have told me they don't like the fact that the Fed injects money into the economy by, say, buying bonds. Why not directly inject it in where it benefits people? Right. So then I go through this thought experiment where I compare it to, like, suppose the government said, from now on, we're not going to buy bonds to inject new cash into the economy. We're going to pay government workers salaries by doing so. Well, if you actually follow through with that, it's really no different. So by paying the salaries, they don't have to borrow as much money to pay the salaries because you're paying with newly created money. So the actual amount of debt held by the public is exactly the same in those two scenarios, whether the Fed buys the bonds or whether they pay the government workers directly. So what looks like a very different system is really pretty much the same system. Now, a helicopter drop is different from paying government workers with newly created cash, because when you contemplate a helicopter drop, you're contemplating two things at once: an easy money policy and fiscal stimulus. right? That's different from paying government workers that were going to be paid anyway, okay? And if you're doing both of those things at once, what you'd really want to compare it to is buying government bonds and simultaneously doing that same welfare program through traditional means. Okay, do you see what I mean? So a helicopter drop can be broken down into two parts. You could drop enough to give everybody in the country $1,000 from a helicopter, and that's both money creation and it's fiscal stimulus. Or you could do this. You could write checks to everyone in the country for $1,000 like we recently did in our COVID stimulus, borrow the money to do that, and have the Fed buy those bonds with newly created money. Okay, my point is those are functionally identical policies. In the helicopter drop, we just drop the money out of the helicopter. The government, the Treasury is not involved at all in terms of the bond market, right? It's all the Fed's doing this. But in the traditional way of doing it, where we send checks from the Treasury for $1,000 to everyone, we get the money for that by issuing Treasury bonds, and then we have the Fed buy those Treasury bonds. Well, the Fed is just buying back the government's debt. If the Treasury issues bonds and the Fed buys those bonds, it's as if the bonds never existed in the first place. Like if I took out a mortgage on my house and I became a counterfeiter, printed some money, and bought back my mortgage from the bank. It's as if the mortgage didn't exist. I bought the house with counterfeit money, right? So, I mean, the whole thing of the debt isn't really fundamentally what's going on in that case. It's really about the money creation and the fiscal stimulus that's occurring. So I think that people tend to worry too much about the fact that the government traditionally injects money or removes money by working with the bond market. It's really just because the Fed thinks it's convenient. It's not because they're trying to favor the financial system over real people. And again, the decision to give new money directly to real people is an interesting decision, but it's very different if you do it by pre-existing obligations like paying government workers' salaries with newly created money, right? There's nothing fundamentally interesting about that. A helicopter drop is very different in the sense that you're actually doing fiscal stimulus too. You're not just putting new money in the economy, but you're giving people money they wouldn't have otherwise received, right? So that's a fiscal stimulus. It's like a welfare program. So I think it's really important to be clear in our minds the distinction between how the money is put into the economy and whether doing so is associated with a welfare program or is just an equal swap for something else, like buying a bond of equal value or something.
So I actually have the opposite kind of, I don't want to say concern, but surprise. I'm actually surprised this isn't a bigger issue because the political issue, this is a political conversation we're having here. And I want to be clear, like I agree with your technical assessment, of course, that, you know, when the Fed creates money, it's not just, it can create all the infinite amount of money. It has to somehow get it out there and has to choose a transmission mechanism, right? Typically goes that through asset markets, but it could go through, as you say, pointed in a couple of examples there, through some kind of fiscal stimulus or some magical thing that is fiscal without the government. Totally understand those distinctions, but I'm surprised that we don't see more political like compare this to say like stock buybacks, right? In the stock market, people kind of freak out about that because they see this as being an artificial increase in the stock price by a company buying its own shares and extinguishing them or just sitting on them. And to me, like the result on the asset market being the stock is the similar kind of effect that the Fed has on interest rates when it buys, say, treasury bonds or whatever it buys, right? It's sort of it's adjusting it's actually, in its rhetoric anyway, explicitly targeting the outcome, the market outcome of an asset by then buying and selling in that asset market. That is like, that's a complicated kind of thing. Actually, it surprises me that people don't freak out politically about that by misunderstanding it more often. Because you could easily come up with this argument saying, well, you're just benefiting the fat cats on Wall Street by making them rich in order to get the money back into the economy. Why are you picking favorites there? To me, the political question is, can you decide on, or can you get the transmission mechanism to match a political agenda, be it egalitarianism, everybody gets $100, or being it let's pick government workers as the winners, or let's pick hedge fund managers as the winners? It seems to me that we don't have that conversation as often as I would have expected.
I think there's a very simple reason for that. Monetary policy is just very sort of esoteric issue. It's hard for people to understand. most people just don't pay a lot of attention to it. And I think in our political system, most people look at outcomes. So to the extent people are paying attention to monetary policy, it's when they grumble about inflation or various outcomes of monetary policy. There are definitely a fair number of people, including maybe most of your listeners, that do know something about monetary policy. And there are different camps, different points of view. There's, the Austrian school critique. There's the MMT critique. There's a lot of heterodox theories of monetary policy. And there's people that are critical of the Fed's structure, the fact that, bankers have a role in the policy deliberations at the regional banks. So there is sort of at a smaller level a political element to this, but it doesn't really reach a mass audience because the average person just finds all this confusing. If you talk to most people about monetary policy, they probably think in terms of the Fed adjusting interest rates, right? They don't even think in terms of the money creation as being central. And I think most people probably don't even understand the distinction between a gold standard and fiat money. They in the back of their minds, they probably sort of still think our money is backed up with something. It was an interesting question as to whether, our money is a liability of the government. You actually see economists debate that issue. But I mean, these things are kind of tricky issues. So most people, I think, just look at the outcomes, and if they're unhappy about inflation, they vote for different politicians and so on. But I think it's very hard for most people to understand, the critique of, the Fed buying government bonds rather than injecting money into the economy in some other way. Here's another example. When I talk to average people about money injection into the economy, it quickly becomes apparent that people aren't distinguishing at all between fiscal and monetary stimulus, right? So they've read a lot about, a big stimulus bill, and they think that's money creation. But fiscal stimulus, even a $2 trillion fiscal stimulus coming along, doesn't create any new money at all. It just moves existing money around in the economy. So people aren't even distinguishing really between fiscal and monetary policy, typically when they think about these issues. Now I'm talking about average people, the 90%. Maybe 10% of the people follow the news closely enough where they do have some knowledge of how the Fed operates and some of these issues that are criticized. And at the political level, the issues you raise, I think, are starting to rise mostly because the Fed's footprint is getting larger. So they used to just buy treasury bonds, right? Now with all these recent crises, they're going to mortgage-backed securities. They've gotten a little bit into the corporate bond market. There's debates about whether the Fed should have a climate policy favoring loans that don't, worsen our environment. There's discussion of inequality. Should they buy municipal bonds? There's a lot of awareness of the Fed's role becoming larger in recent years. And as a result, I think it is becoming a little bit more of a high-profile political issue than it was when things were more calm, say before the Great Recession. There was a long period where people in both parties seemed happy with Fed leaders like Greenspan and, just thought things were going along fairly well and didn't want to rock the boat. But when you have problems like the Great Recession or the COVID crisis, then it becomes more of a high-profile issue. And also, again, the Fed's footprint is so much larger. The monetary base, that is the amount of cash and bank reserves they've injected in the economy, has become so large that they've had to buy many more assets, even unconventional assets, than in the past. And that large footprint has made them more controversial.
So I think you appeared a moment ago to be a little ambivalent about the transmission mechanism I'm describing it anyways, as markets. Is it fiscal policy? Is it something else? But I'm wondering whether there are technical arguments to prefer one or the other of a transmission. I mean, I don't know if anybody's looked into this. Because to me, you're at least alluding to the possibility of distortion in certain markets by the Fed's reliance on asset purchases, and you're exposing it to a certain political vulnerability. And on the political point, there was one thing that just came to mind that I'd like to at least make the point. At least economists aren't immune to political preferences, right? I mean, even if the subset, it kind of doesn't matter how small the subset of the population is that understands it. It still surprises me. This is not more politicized, and as you say, it's probably getting more politicized now. But if we could make it, if we could somehow, maybe that could be an objective of Fed policy, would be to find the least politically volatile or risky manner of transmitting policy. So I wonder if I could get you to come down and maybe with a preference for how you might design. Again, we assume that we can do anything in our crypto world. We'll come back to that. Would it be better for the Fed to do helicopter drops, or would it be, or by the Fed I mean our cryptos, AI or something like that, or should they intervene in asset markets? Is there any reason to prefer one or another of these mechanisms?
So I'll put my cards on the table. I'm more of a small government free market economist. So I would prefer the Fed's footprint to be as small as possible. And for instance, that's one reason why I oppose the payment of interest on bank reserves. That's one policy that's made the Fed balance sheet bigger. And in terms of distortions in the economy, I'd prefer they just buy back Treasury debt. The Fed is functionally part of the federal government in a fiscal sense. So all the profits from the Fed basically go back to the Treasury beyond what they need to operate. And so when they buy back Treasury debt to issue new money, they're not distorting the economy very much. That's the least distortionary way to inject new money into the economy. I'd rather they not pursue other goals. I mean, climate goals are probably valuable, but I'd rather elected officials pursue those goals. Fed policymakers aren't even necessarily government officials. The ones at the regional banks are not technically part of the government. So I'd prefer the Fed go back to the pre-2008 system where the Fed balance sheet was relatively small. Open market operations where they injected new money were very, very tiny relative to the size of the economy. Just to give you an idea, before 2008, 98% of the monetary base was currency, literally the stuff in your wallets. Only 2% of the monetary base was electronic bank reserves held and deposited at the Fed. Now, most of the money is bank reserves. We still have a lot of currency out there, but what's really ballooned is bank reserves. So the Fed has become much, much larger. I mean, many orders of magnitude larger in terms of its impact on the banking system. And this is a policy that I think was unfortunate because it's inevitably going to lead to growing politicization of the Fed, and arguments about what it should be buying and so on. So I really like the pre-2008 system better. It was less controversial. It seemed to work pretty well, and it had a much smaller footprint on the economy.
That's a phenomenal lead-in, Scott, to some of the more interesting ideas that you've taught me through your blog, because one of the most interesting things, and there are many, is that the Fed's balloon and balance sheet was a failure, but not necessarily a failure in the sense that it bought too much. Well, is that it had to, right? And so, you've talked about how the absence of a sufficient trust in the Fed actually doing what it says forces it to act more than it would otherwise. I wonder if you could talk a bit about this idea of if the Fed actually could credibly commit to a certain price level target, they wouldn't need to buy anything, and they, in fact, in ironically, certain scenarios would actually sell to generate the right kind of outcome, even though they had to do quite the opposite after 2008.
Right. So when I talked about the small Fed balance sheet back before 2008, I was referring to the monetary base, which was mostly cash at the time. And in most developed countries, including the US, that would be less than 10% of GDP, the size of the money created by the Fed. And that's the total stock, not annual flows, which are even smaller. Now, if you look at a country like Japan, their monetary base is 140% of GDP, massively larger than before. Mostly extra bank reserves, and mostly because The Bank of Japan has let inflation and interest rates fall to such a low level that sitting on bank reserves is actually a profitable investment. So in my mind, you want an economy where things are growing fast enough in nominal terms that people don't want to just sit on cash and hoard lots of cash or bank reserves as an asset. You want the monetary base to be less than 10% of GDP, not 140%. Now, what's kind of ironic and confusing, I call this an Alice in Wonderland world, is things are never as they seem in monetary economics. So on the one hand, on a day-to-day basis, injecting more money into the economy is expansionary, it's inflationary, it tends to push up inflation. But on the other hand, as inflation rises, people don't want to hold as much money. So the demand for money as a fraction of GDP is much less when you have higher inflation. So the example I like to use, if the Bank of Japan were to raise the Japanese inflation rate from near zero to say 5 or 10% a year, people in Japan wouldn't want to just sit on a lot of zero interest cash and bank reserves any longer. So the demand for money would fall sharply, or if you prefer, the velocity would increase very, very sharply. Instead of holding 140% of GDP in base money, the Japanese would probably hold less than 10% of GDP. So a successful inflation policy in Japan, while it might require some monetary injection in the short run, would actually over time result in a much smaller money supply as a share of GDP than their current monetary system. And this Alice in Wonderland world also applies to interest rates, where things are never as they seem. So an expansionary monetary policy might involve in the short run a reduction in nominal interest rates. But if it creates inflation, that inflation will eventually push interest rates higher. So if you had a truly inflationary policy in Japan of 5 or 10% a year inflation, interest rates would actually go up. It wouldn't be tight money, it would be inflation that's pushing interest rates up. So these things are often very confusing because people like to just sort of look at the money supply or look at interest rates and think they know everything they need to know about the stance of monetary policy. But you really need to look at these things in the context of the demand for money to fully understand what they're telling us.
And that is proxied by velocity, right? So how much money is spent?
Right. So velocity is kind of the inverse of the demand for money. So let me see if I could give you a numerical example. If the amount of cash in the economy, let's say, is 1 divided by 52 of people's incomes, or of nominal GDP, 1/52nd of nominal GDP, then to support all those transactions, the cash would have to be spent 52 times a year, right? So let's say you had an economy where GDP was 52 billion and you had 1 billion in money, right? So velocity is 52. The money has to be spent 52 times a year to support all those transactions. But your demand for money as a share of GDP is 1/52, roughly 2%, right? So you're holding a stock of money that's roughly 2% of your annual income. So what we call the demand for money, how much money you want to hold, say, as a share of income, is really the inverse of the velocity of circulation. Does that make sense? Or
yes. No. I love it. Here's kind of one thing that I was puzzling over, really literally just before we started, trying to kind of work out my thought. Normally I like to try and do this before I ask you the question, but we'll see how this goes. So one of the points you make in the book, and I've seen it elsewhere, is that productivity growth actually is deflationary, right? And one of the things that confuses me a little bit about that is this concept of I want to hold so much money in my bank account or my hand. I want to have this much cash. And if productivity growth increases, suddenly I wind up spending less for the current consumption level. Let's say since this week I bought so much stuff. Next week productivity goes up by 10%. Everything costs 10% less. Let's say that's the way it happens. Now suddenly I have more money in my hands. That suggests to me that I would want to spend that money, right? So I'm drawing an analogy here to another explanation, which is that we have this sort of reserve level of currency. We want to hold a certain amount of money and everything else we spend, right? So if I were to then spend that money, that would be inflationary, I would think. So I'm wondering about how productivity growth fits into this, if I'm thinking about it right.
No, in that case, you're not thinking about it right because when you spend money, it doesn't mean there's any more or less money in the economy. What we really need to think about is how much money there is in total in the economy. So then that's determined in this assumption by the Fed. Here I'm talking about Fed-created money like cash and bank reserves. So if you have a certain stock of Fed-created money that's determined by the Fed, if you spend more, somebody else receives more. So the minute you have less, somebody else has more money in the economy. But for any given stock of money, productivity growth is going to be deflationary because what's going to happen is you'll get more output and less inflation for any given level of nominal GDP. In terms of the aggregate supply and demand model, this would be like the aggregate supply curve shifting to the right, which will result in a new equilibrium with a higher real GDP and a lower price level. Okay. Now, this fallacy of composition is really central to monetary economics. What's true for the individual is not true for the group. So, to me, the most fundamental insight of all in monetary economics is that the Fed controls the nominal stock of money and the public controls the real stock. So we all feel like we control how much money is in our wallets, right? We just feel like the Fed can't tell us to hold more or less money. And that's a very strong instinct we have. Like if we don't want to hold so much money, we can spend it, put it in the bank, whatever, get rid of it. But at a collective level, that's not true. Like collectively, the public can't get rid of excess money holdings. When they try to, if the Fed puts more money in the economy than people want to hold, and they try to get rid of excess cash balances, what will happen is their attempt to get rid of this extra cash by spending it will push up prices until prices are so high that we again want to hold that extra money because now we have to pay more for things. And so in that new equilibrium, the public has determined the real amount of money that's in the economy, and the central bank has determined the nominal amount of money in the economy. So each group is sort of right in its own way. The Fed thinks it can control the money stock, and it can control the nominal money stock. The public thinks it controls its money holdings, but it actually controls its real money holdings, not its nominal money holdings. And the interaction of those two groups is what makes monetary policy have macroeconomic effects. So the Fed puts money in the economy that people don't want to hold, and a new macroeconomic equilibrium is achieved where they then do want to hold that money because prices and output have changed to make the public want to hold that extra money.
So what I'm kind of hoping is happening, is in my mind and in listeners' minds, is that this is getting kind of weird because if you think about the world where, back to your Japan example, or your point there about if you increase inflation expectations, people want to get rid of their money because the money is getting worth less, right? Why would I hold on to this thing that's depreciating by 10% a year to get rid of it by spending it? And then then the Fed's got to pull that money out of the system because now suddenly everybody's spending all this extra money that's in there, and so the central bank has to soak up all that extra cash, lest inflation go way up, right? Overshoot. Right. And so they're going to have to start, once people get in their heads that, I got to get rid of this stuff, it's very easy to kind of to overdo it. Right. And so they got to pull the money out. The interesting problem then is what makes them think that it's going to get 10%, that the inflation is going to come. How do you convince them?
Well, first of all, they don't always make the right decision. In the 1960s and 70s, they didn't pull the extra money out. And we had, 10% inflation during some years in the 70s.
Do you know why?
Well, they had bad models. They were making 2 or 3 intellectual mistakes. It wasn't bad intentions, I don't think. They had a Phillips curve model that convinced them that they could permanently lower unemployment by having a little bit more inflation. So that was one mistake. A second mistake was they misjudged the natural rate of unemployment. It actually rose somewhat in the late 60s and 70s. So they were aiming for an unemployment target that was unreasonable. They were chasing a goal that was unachievable. They misjudged the stance of monetary policy because they thought nominal interest rates measured whether money was easy or tight. And since interest rates were fairly high in the 70s, they thought they already had a tight money policy. But in fact, interest rates were high because of the high inflation. and monetary policy was not tight or contractionary. So there's three right off the top, three intellectual errors the Fed made, and that were all corrected in the 80s, and they brought inflation back down with a different regime, a different approach for targeting inflation. And really, ever since the 80s, central banks have known how to keep inflation under control. In fact, you could say there's actually been two big learning curves in the last 100 years in macroeconomics. We had the Great Depression, and then central banks learned how to prevent something that deep. Although I argue they made a similar mistake in the Great Recession, but much smaller mistake. But they learned how to prevent Great Depressions by doing enough stimulus to prevent, 25% unemployment. Then they made the opposite mistake in the 60s and 70s, and we had very high inflation. Some people call that the Great Inflation. In the 80s, they figured out how to avoid that. Not just the Fed, but all the major central banks of all the major developed economies. None of them really have high persistent inflation. The only countries in the world now that have high inflation are developing countries with severe political problems, Zimbabwe or Venezuela, places like that. So we know how to, control high inflation. We know how to prevent deep depressions. Now we're engaging in the fine-tuning part of it. Like, okay, how do we prevent smaller recessions? How do we prevent smaller outbreaks of inflation? So we're still making mistakes, but we're making smaller mistakes than in earlier decades.
And so does
that make sense?
Yes. The important thing that I want to kind of get to, and I interrupted your train of thought, but is how these expectations are actually set. And here's the thing that kind of like still bothers me about this. So, there's this, you've talked about it elsewhere, but the Princeton School of Economics, where you had this revolution and really understanding, or starting to really study and understand how expectations of future Fed action, or of outcomes the Fed's trying to go for, really actually govern monetary policy. So it's this other thing, right? It's the thing that exists in between. It's just like a human, it's a social fact, right? Of the somewhere between the Fed communication and the economy's understanding exists this idea of what we think needs to happen, or what the Fed will do. And it's not measurable by money, right? And you can measure it in certain ways, and you talk about using forecasts and stuff, which I do want to get to, because I think it's amazing. But this kind of social fact of the expectations, that creates what though? So is it just the aggregation of many businesses now having this sort of expectation that they adjust all the little micro decisions that they're making to suit this new reality because they believe in it? Is that actually the real transmission mechanism for monetary policy, as opposed to all this crazy technical stuff about asset markets?
Well, I think expectations are very important. How they're formed is an interesting question. There's a school of thought I adhere to, which is unfortunately called rational expectations. But it sort of implies that the term implies people are like a Spock on Star Trek, machine-like thinkers that can rationally see the future. But rational expectations actually should be called consistent expectations. That is, what we're really assuming here is that the public's expectations are consistent with our model of the economy. So if we think a certain policy will produce this outcome, we're assuming that the public also has that view, because we have no reason for them to assume anything else. In other words, if we have a model where the model predicts the policy will produce 4.5% inflation, it would be weird to put in the model a public that believed inflation was emitting 9% or 1%. Like, why would you do that? It's not that I think the public will exactly have 4.5% inflation expectations. But I also believe in this concept of wisdom of crowds. That is, when you aggregate the forecasts of a very large number of people, often the results are surprisingly accurate. You've probably heard of the jelly bean experiment, where you ask 100 people how many jelly beans are in that jar. Well, nobody really has a clue, right? I mean, you look at a jar, how could you guess? And yet when you average all the guesses, it's actually pretty accurate to the number of jelly beans that are in the jar. So I also believe that certain expectations are more important than others. So let's take a money supply announcement. The Fed makes a money supply announcement. The financial markets instantly react. The stock market jumps 5% within minutes of the announcement. And this happens sometimes. I could cite examples. 5% jump in the stock market within minutes of a Fed announcement. I don't think the public actually looks at the Fed announcement and has some kind of new Keynesian model of the economy and figures out what that'll do to, the economy. Rather, the public looks at the stock market jumping 5% and takes its cue from those people. So in this sense, expectations are formed at two levels. Insiders, specialists that follow Fed policy closely, try to figure out what its implications are for the economy. Their conclusions drive asset prices quickly in response to those Fed announcements. The public sees the movement in asset prices and draws inferences from that. So in other words, the transmission mechanism is very complex. And even what I just sketched out, I'm sure, is a gross oversimplification of what actually goes on. I also believe that central banks are relatively easy to read. So a lot of times I'm asked, well, just because the Fed promises to do something, why should people believe it, right? And I don't think they necessarily will believe it. I think what people will believe is they'll believe what the Fed is actually going to do, right? So during the 1970s, the Fed promised to do something about inflation, and they didn't. And they were not believed for very good reasons. They weren't really sincerely committed to doing something about inflation. But if a central bank really was committed to reduce inflation or create inflation and was going to do, this is an important phrase, whatever it takes to do that, I believe they will be believed. Like the public will believe them. I think of central banks as like this person I know whose face is very easy to read. You look at her face, you can tell her emotions, happiness, anger. It's just right there on the face, right? No hidden agenda, no hidden motives. And, the Fed is a big public institution with a lot of people within the institution that speak publicly, have different points of view. It's not at all hard to figure out what's going on in the quote, the mind of the Fed. One reason the economy did so poorly in late 2008 is people correctly understood that the Fed was not going to do whatever it takes to prevent a deep recession. So, there's a lot of discussion about, forward guidance and how the Fed can shape expectations to stabilize the economy and so on. But most important of all, the Fed must ultimately be determined to do what it promises. That's the hard part. Once it's decided it will do whatever it takes to achieve some longer term objective, I believe the public will come along. They'll believe that objective. That'll be credible. Now, if they've been dishonest in the past, it might take a little while to establish some credibility. But I think the expectations are on average going to be roughly what the Fed is sincerely going to do.
Now, the thing that still kind of bothers me is if you think about the actual outcome of NGDP or of let's call it wages, the real wage. Just put it this way: the real wage, which is nominal wages adjusted for, divided by the price level, right? Some adjustment for the price level, right? Those are private company decisions. Both of those things, the prices and the wages. So companies who pay people, and the governments, I suppose, who are a big part of the economy, they have to make decisions about wages and prices that result in an outcome that is then counted as NGDP and inflation. So somehow these organizations have to have so to me, that's why I kind of come back to this, the expectation of the Fed actually results somehow in decisions by individual companies to do things. And those decisions surely are the real ultimate transmission mechanism of monetary policy, right? Be it whether they're forced to or something else. Right now we're in an economy. We're recording this in October 2021, which is pretty hot. right now, in GDP growth. You wrote a blog post this morning or yesterday, I think. You said we've kind of reestablished we've plugged the nominal hole from the beginning of COVID, and so so companies are actually making decisions now that are resulting in higher than GDP. Why does asset markets are predictions of what companies will do, right? So I get that. So that's the experts, as you say, are saying, well, here's what I think the company's going to do, and they're going to make more nominal profits, and that's going to make their nominal asset value go up. And then the public is going to anticipate the company's decisions as well, which is I'm going to get more money and things are going to cost more. And so both of these things are, it's a mixed bag. But why aren't the company's actual actions, the micro decisions there, featuring more prominently in at least your description of the model?
Well, that's a huge question, and it's a very difficult question to answer because this kind of works on several levels. On the one hand, let's start with the long run. So in the long run, the Fed is determining nominal values in the economy, nominal wages, nominal prices. Even the allowance I might pay to my daughter in nominal terms, that's controlled by the Fed, not by me. In real terms, all these things are controlled by agents in the economy, right? So that's the long run, though. Why is this so confusing? Because in the short run, it's not true. And we tend to observe life in the short run. We experience life in the short run, right? So in the short run, we control both the real and nominal wages, real and nominal prices, the real and nominal allowance I pay to my daughter. Those are all controlled in the short run by agents in the private economy. Somehow we have to have a system or a model where we can transition from the short run to the long run. And the so-called transmission mechanism of how that changes is not easy to understand. Okay. It seems to be partly related to this notion of disequilibrium, at least in some industries. So if you have, expansionary monetary policy where at existing prices and existing wages, there's not enough goods, there's not enough workers, then you have at the micro level people bidding up wages and prices. So those nominal wages and prices start to rise to reflect the new money supply. But, wages might be adjusted only once a year. So the process is very confusing. Now, if you had a perfectly flexible price economy, then these adjustments would take place right away. And we wouldn't see any real effects at all. And in fact, I sometimes like to talk about the example of currency reform. This is very far from the minds of most Americans because we don't live in a country that has had currency reforms. But if you've lived in Mexico or another country, you may have gone through this. So after a while, they've had so much inflation, they'll take 100 old pesos and go to one new peso, right? Well, after the currency reform, basically all nominal values in the economy go down 99% instantly. Like in one day, you go from the old pesos to the new pesos, everything is 99% cheaper in nominal terms. In real terms, nothing has changed. Now, if we ask, well, why doesn't that huge deflation, that huge drop in prices, create all sorts of economic problems? The reason is simple. With the currency reform, all wages, prices, and even debt contracts are 100% flexible. Like everything's adjusted immediately. Not only do you do 100 old Mexican pesos for one new Mexican peso, but your salary immediately drops from, 100,000 pesos a week to 1,000 pesos a week or whatever. Your mortgage is adjusted 100 to 1, right? So if all contracts are immediately adjusted, then that kind of monetary policy change only shows up as nominal changes. Nothing real matters, nothing real changes. But what actually happens in the US economy is we have this kind of complicated process where that's still the long run equilibrium. Like if the Fed doubles the money supply, other things equal, in the long run, the only thing that changes is all wages and prices will double. That'll be the effect of doubling the money supply. But because wages and prices and debt contracts are sticky or negotiated in nominal terms and are adjusted infrequently, the short run effect is for all sorts of real things to happen. Disequilibrium occurs in the economy when you have a monetary shock. And that disequilibrium sets in motion things that in the long run will produce the desired nominal change. So in that long run, money is neutral. It has no real effects. You just have the nominal wages and prices adjust. But because of short run rigidities in the economy, you get disequilibrium, and that creates bidding up process of wages and prices, or bidding down if you have a deflationary monetary shock. You force wage cuts, you force price cuts. That's when you usually have unemployment occurring because it's hard to cut wages. So, in terms of the actual transmission mechanism, I mean, there's like 1 billion transmission mechanisms because monetary policy creates all these little disequilibriums all across the economy when the money supply is adjusted. It's just working through the housing market, it's working through the stock market, it's working, foreign exchange rates change, wages become under pressure if there's unemployment, or if there's a shortage of workers, wages go up. It's just a million areas where you're getting little incremental changes in response to this monetary shock. But again, all of these incremental changes are only occurring because of stickiness. It's weird, like if wages and prices were 100% flexible, like in that Mexican currency reform, you just have the whole adjustment occur at once. Everything nominal would be adjusted and nothing real would change in the economy when that occurred. Another currency reform example is the euro. Like nothing real changed in Europe when they went from French francs to euros or German marks to euros. It's just a different accounting system, like changing the length of a yardstick. But because we have stickiness in prices for these gradual changes in monetary policy, that's why you get these messy adjustments to monetary shocks.
That kind of touches on the aspiration of my crypto example, right? Because if it is a very simple thing. You're saying the downward stickiness is the original sin here. That's the thing that makes all this stuff be weird. Then in a world where you could arbitrarily make those adjustments through monetary policy or some kind of anyway, if you could design a mechanism that would correct for that at the ground level, perhaps you could actually fix that in a more elegant way. But we don't have to keep going on about that. The thing that I am curious about, I'm going to come back to this question of the expectations as it interacts with what you're saying, the disequilibria, because when I kind of have this sort of urge to say that I feel like in an expectations-driven monetary policy regime, the actual money that's created is kind of pulled, or rather there's a change in the demand for money, and then the thing, because of expectations of monetary policy, right, or of expectations of inflation and in GDP, right? So that changes kind of how much money the public wants, because they're going to create that reality through these disequilibria. They are making up these disequilibria, right? The Fed's not going around and adjusting all these marketplaces. They're saying, here's where the world's going to be, and everybody says, holy cow, now we're out of equilibrium. But it's just a change in their mental state. Like they are making that happen themselves, right? It's all these micro.
Well, let's be clear. The Fed is not trying to create disruptive disequilibrium.
Right.
So they have their goal of 2% inflation target, and they're trying to match the public's changing demand for money in such a way that inflation will stay close to 2%.
Yes, that's kind of what I'm getting at here, because the public, let's say the public suddenly gets in this bad macro equilibrium where their demand in money has changed for some reason. The Fed wants to reset their expectations so that they reset their demand for money to some other level, right? And so now we kind of have this 3-step process. But the Fed hasn't done anything yet. All they've done is change their expectations, right? And it's like, Powell goes out there, who's the current Fed chairman, right? Is he still? And then we'll say, here's the new expectations, public. Public says, done. Now they go about busying about their lives, acting on those expectations, which are creating these little micro disequilibria. And then the Fed now has to just watch that and hand them the right amount of money, right? Right. So it's got to react to what it will see as the new velocity given its new expectations. And so to me, the Fed is setting up the expectation, then it's going to be as a highly reactive institution, not screw up the amount of money that gets in there. Because if they overdo it or underdo it, you're going to wind up in the wrong place and you're going to mess up the right, so how do they do that? How do they know how much money to actually put in the system?
Well, that's a good question. So there's the easiest one to answer is probably the very, very short run fluctuations are mostly handled via interest rate targeting. Right? So let's say there's more money needed at Christmas. Okay, people are doing more shopping, and this is true, by the way. There is somewhat more money in circulation in December than the other months. And how does the Fed know how much money to inject during December? Well, if they're targeting interest rates, then if there wasn't enough money, interest rates would sort of start to rise as banks are trying to get their hands on more money to meet customer demand for withdrawals from ATMs to go shopping, whatever. So to prevent interest rates from rising, the Fed will inject money in the economy, holding interest rates stable during December. And that keeps the money supply matching the demand for seasonal changes. These are the easiest to address. They're kind of predictable seasonal changes like Christmas shopping. And one reason we know this is true is that before the Fed was created in 1913, interest rates did move around seasonally. I think late in the year, interest rates tended to go up, as I recall, because there wasn't a Fed to meet the demand, right? So there were these seasonal fluctuations in interest rates. Now, the seasonal thing is easy to deal with, and we're not even trying to stabilize the economy over the year. We're happy to have GDP a little higher in December than January, right? So the bad kind of fluctuations are deep recessions and overheated economies with high inflation. For those, they need models, and it's not enough to peg interest rates, because if you peg interest rates for a long period of time, and the equilibrium interest rate is changing, and you're not changing the target rate at the Fed, then interest rates will get out of equilibrium and the economy will spiral off course. If interest rates are too high, it'll spiral downward. If they're too low, it'll spiral upward. So the Fed's developed techniques, things called like the Taylor rule for adjusting interest rates. I'm personally not a fan of interest rate targeting, but most economists disagree with me. But you could, the Bank of Singapore targets exchange rates as a way of stabilizing their economy. And the Fed is constantly looking at all sorts of data to try to sort of predict where things are going. It's sort of like imagining someone driving down the highway and it's kind of foggy and they're trying to stay in their lane, but they can't see too well. They're looking for any indicator that they might be drifting over the center line or off to the shoulder. And then they adjust the steering to try to stay in the lane. And it's even worse if the car adjusts slowly to the turn of the steering wheel, right? You'd like a car like, I don't know, Ferrari that responds quickly. So the Fed's got this steering wheel. They turn monetary policy, but the economy is like a big ocean liner. It doesn't move right away in response to the monetary policy. So it's often difficult for the Fed to provide the amount of money that allows them to hit their macroeconomic targets in an appropriate way. Nevertheless, at least when interest rates are above zero, they did seem to be sort of figuring this out to some extent in recent decades before the zero interest rate environment kicked in. They were making less bad mistakes than in earlier decades. Then when interest rates fell to zero and they were no longer able to adjust interest rates as a technique for steering monetary policy, we made some significant mistakes around 2008 and 9. But, there's no simple answer to your question. Again, in the short run, targeting interest rates will meet little seasonal fluctuations in demand for money. But to control the business cycle, you need something more than that. You can't just stabilize interest rates forever. The Fed, by the way, generally adjusts its interest rate target every 6 weeks, if you want a sort of time frame on that. So that's good enough to handling like Christmas shopping and so on, but not good enough for long-run macroeconomic problems. And they look at all this data. They have forecasts. They have models, which are not really very good models. As your listeners probably know, economists are notorious for not being able to predict recessions very well. And they do the best they can. Now, my preference, and I guess we'll probably get into this, is that they should let markets steer the monetary policy. But anyway, that's basically what they do. They look at a lot of data and try to figure out as best they can what kind of interest rate adjustments will keep inflation close to 2%.
You did very accurately predict my next and perhaps final move for our conversation, which is the real thing is actually, as you say, they look. So if I may characterize your comments there, they look at market prices when they decide how much money to put into, and you said interest rates, and you also say these sort of economist models, which I'm sure are very good, maybe not, but we know the market prices are, well, I mean, I learned much of my faith in market prices from you, actually, Scott, over the last 10 or 12 years, how long you've been blogging, and what we know is that markets are really the best forecast for what's about to happen. And interest rates are a kind of, where they are, as a market price, they are a forecast. But there are probably better ways or better aggregates to develop markets for that would give the Fed real good guidance on exactly how much money to put in the economy. So maybe it's a good time to talk about another amazing idea that I learned from you is NGDP futures. What would those be? And how might the Fed use that?
Right. So, excuse me. It doesn't have to be NGDP futures, by the way. If you target inflation, you could have inflation futures. And we actually have something that's a little bit similar to inflation futures already. So I think it's worth mentioning that this isn't completely a hypothetical idea. We have something called the tip spread in the bond market, the difference between the yield on nominal bonds and indexed bonds. And that's a rough estimate of the amount of inflation people expect over various time horizons. So we do have market indicators of some of these variables. I favor targeting nominal GDP. We do not have any kind of direct measure of the market forecast of nominal GDP. We can kind of put it together by looking at a lot of market indicators and try to infer what the markets seem to be expecting about nominal GDP. But I've proposed we actually create a nominal GDP futures market. And not just create one, but have the Fed stand willing to take unlimited positions, short or long, at certain price points. Okay, so let's say the Fed's goal is 4% nominal GDP growth. So you're going to have a nominal GDP futures contract where the maturity value depends on the actual growth in nominal GDP. And one idea would be just to have the Fed peg the price of that contract at 4%. At 4% growth. That might be a little bit extreme. So more recently, I proposed what I call a guardrails approach, and it would work kind of this way. People that thought nominal GDP was going to grow faster than target, faster than 4%, would take a long position on these futures contracts because they'd expect a profit from the higher than expected NGDP growth. Those that were bearish on the economy, expected slow growth, would take a short position on the contracts. So the Fed would have guardrails at 3% and 5%. And the Fed would tell the market, we'll take a short position on any 5% contract. Like, we think nominal GDP growth will be less than 5%. If you disagree with us, bet with us on this contract. You'll profit if it's more than 5%. We'll profit if it's less than 5%. The Fed would also tell the market, we'll take unlimited long positions on a 3% contract. So we think nominal GDP growth will be more than 3%. If you think it's going to be less than 3%, go ahead and take a short position. We'll take a long position on that contract. And these would be sort of warning signs for Fed policy. So if the market was all over on one side or the other, it would suggest monetary policy is probably off course. We're not going to get 4% growth. Like in late 2008, everybody in the market would have been taking short positions, expecting less than 3% NGDP growth. I compare it to the beeping noise a truck makes backing up. It's kind of like warning you might hit something. Now, you can still back up if you want to. You can ignore that beeping noise. And the Fed can ignore those contracts and say, well, we think we're smarter than the market, and we're just going to do this policy anyway. But of course, if the Fed is wrong and there's a deep recession or high inflation, they're going to have to go to Congress, explain to them why they thought they were smarter than the market, right? And why they were wrong. So I think what would actually happen is Fed policy would be continually adjusted in what I call a whatever it takes approach. They would do whatever is necessary to keep nominal GDP expectations for future growth within that 3 to 5% range, which is consistent with macroeconomic stability. So essentially, the market would be guiding, like, think of it this way, the market would be telling the Fed what sort of interest rates and money supply it needed. Just like a country that has a fixed exchange rate system, the market tells that central bank what kind of interest rates it has to have to keep its interest rate fixed. I don't know if you follow, like Bretton Woods, or today Hong Kong's dollars fixed to US dollar. They don't control their interest rate, the market does. There's a certain interest rate that is necessary to keep the exchange rate fixed. Singapore, they target exchange rates. So the market tells them what the interest rate will be given their exchange rate target. And under my system, basically the Fed would no longer target interest rates or exchange or money supply to any significant extent. They would essentially be following market directions on what kind of interest rate or money supply is necessary to keep expectations of nominal GDP growth on target.
Well, a question I have about the futures, and I've been kind of wondering about this ever since you've been mentioning these for as long as I've been reading you. If let's say the Fed adopts a short position at 5%, and everybody knows, except maybe the Fed, that the inflation is going to be 6%, and let's say, let's just go the absurd extent here. Let's say everybody in the economy shorts or rather goes long on these futures at 5.5%, and the Fed then pays out. They're putting more money into an arbitrarily stimulated economy. Because one of the things that I was wondering about, was whether there's something special about the payout of the contract as a specific monetary stimulus.
It could be, yeah. In my preferred scheme, it doesn't have any money supply implications. They're just paid with money that's already in the economy. The Treasury writes them a check, not newly created money.
Right. It's only the information value of the forecast. The actual paying of the contracts isn't part of the mechanism.
Now, my original version of the proposal, the money supply would actually be directly adjusted by these purchases and sales and so on. But I kind of thought that's unnecessarily complicated, or I think it's easier to just think in terms of these payouts not affecting the money supply at all, and rather the market is just providing information. And it's also sort of providing an incentive for the Fed not to want to miss the target, because the Fed does not want the embarrassment of losing a lot of the Treasury's money. So in other words, what I think because central banks are conservative institutions and don't like to take risks, they'd rather adjust monetary policy until the short and long positions are roughly balanced. They'll keep nudging interest rates and money supply up and down until about the same number of people are taking short and long positions on nominal GDP growth.
We're out of time. I'm sorry, Scott. I have to end it there. My guest today is Scott Sumner. Scott, thank you very much for being on the show.
Enjoyed it. Very good question.